You've probably heard a ton of asset allocation advice that sounds super smart, but completely fails in real life. And it's not because the math is wrong, it's because we're people, not spreadsheets. We have jobs, we have stress, we have families, we have unexpected emergencies, and we definitely have emotions. So today, we're going to build an asset allocation strategy that actually works for human beings, not for finance textbooks. First, let's get one thing straight. Asset allocation isn't really about squeezing out the absolute maximum return from your money. It's about managing a level of risk that you can actually live with. Think about it. The best portfolio in the world is completely useless if you panic and sell everything the moment the market gets a little shaky. The best plan is the one you can stick with through thick and thin. If you know you won't be able to stay the course when things get stressful, then that plan is already broken for you, no matter what the numbers say. It's about building a financial foundation that's strong enough to withstand your own human nature. Now, you've likely come across those simple, age-based rules, like the classic 100 minus your age to determine your stock percentage. It sounds neat and tidy, right? But it's dangerously incomplete. This formula completely ignores the most important factors of your actual life. It doesn't ask about your job stability or how predictable your income is. It doesn't consider your health or the financial obligations you have to your family. Let's take two 30-year-olds. One is a freelance graphic designer with a fluctuating income, and the other is a government employee with a stable salary and a pension plan. Should they invest their money in exactly the same way? Absolutely not. The freelancer needs a much larger safety net and a more conservative portfolio because their income stream is less certain. The government employee can afford to take on more risk for potentially higher growth. Your personal context is always more important than a generic formula. You have to look at the full picture of your life, not just your birthday. So if age-based rules are out, what should we focus on? Your real-life asset allocation should really boil down to three key things. First, your income stability. How secure is your job? How predictable is your paycheck? The more stable your income, the more risk you can generally take in your portfolio. Second, your time flexibility. How soon will you need this money? If you're saving for a house down payment in 3 years, you need to be far more conservative than if you're saving for retirement in 30 years. Time is your biggest ally in investing, as it allows you to ride out market downturns. And third, and this one is crucial, is your emotional tolerance. How do you react when your portfolio drops by 20%? Are you able to stay calm and stick to your plan, or do you feel an overwhelming urge to sell everything? Be honest with yourself here. If you know you're prone to panic, you need to build a more stable portfolio with more bonds or cash, regardless of your age or income. If any one of these three factors, income stability, time flexibility, or emotional tolerance, is weak, your portfolio needs more stability, not more aggressive growth. It's about creating a plan that lets you sleep at night. So, how do we build a simple, human-friendly allocation? Start with a foundation of broad, diversified equities for long-term growth. This could be something as simple as a total stock market index fund. This is your engine for wealth creation. Then, add a layer of stability with bonds or even just cash. This is your shock absorber. It cushions the blows during market downturns and helps prevent you from making rash decisions. The key here is to adjust the mix slowly and deliberately over time, not to make dramatic, knee-jerk changes. You don't need perfect, pinpoint precision in your allocation. You just need a portfolio that is survivable, one that can weather both market storms and your own emotional reactions. Remember, simplicity is often your best friend in investing. And that brings me to my final point. Stop trying to over-optimize. Constantly chasing the perfect asset allocation is a recipe for disaster. It creates anxiety, and anxious investors are the ones who can't stop tinkering with their portfolios. They're always second-guessing, buying high and selling low, trying to time the market. And study after study shows that these investors consistently underperform those who just stick to a simple, boring plan. A straightforward portfolio may be just 2 or 3 low-cost index funds often outperforms a complex one precisely because it reduces the temptation for self-sabotage. Your biggest enemy in investing is often the person you see in the mirror. So, when should you actually change your allocation? Only when your life fundamentally changes, not when the market does. Getting a new job with a different income structure, having a child and new responsibilities, or nearing a major financial goal like retirement, these are valid reasons to reassess your strategy. The daily noise of the market is not. The goal isn't to achieve the absolute maximum growth possible. The real goal is to make sustainable progress that you can comfortably live with for decades. Build your portfolio for your reality. Thanks for watching. If this idea of investing like a human being resonates with you, comment real life portfolio below. And don't forget to like and subscribe for more content that helps you build a financial life that works for you. See you next time.